Welcome to EnrichMinds.com and our session on understanding an income statement. In this session, we shall learn about the income statement and what it tells us. An income statement is a financial report detailing a company's income and expenses over a reporting period. It can also be referred to as a profit and loss or P&L statement and is typically prepared quarterly or annually. Income statements depict a company's financial performance over a reporting period. Because the income statement details revenues and expenses, it provides a glimpse into which business activities brought in revenue and which cost the organization money. Information investors can use to understand its health and executives can use to find areas for improvement. An income statement is one of the three important financial statements used for reporting a company's financial performance over a specific accounting period, with the other two key statements being the balance sheet and the statement of cash flows. Also known as the profit and loss statement or the statement of revenue and expense, the income statement primarily focuses on the company's revenues and expenses during a particular period. An income statement shows what a company's sales, expenses, and profits were over a given period. The statement can provide valuable information for the company itself in making decisions about how to run the business and also for potential outside investors. Trends in a company's profit and loss statements can give clues about its longer-term business prospects and potentially even alert investors to any red flags. The statements are a vital source of information, but only one small piece of the bigger picture when it comes to analyzing a company. Revenue or sales is straightforward. It puts a dollar figure on how much the company sold in its main business activities. For a clothing store, revenue would mean the total of all sales for the period after any returns or discounts. Next is expenses. The company spends money on all its operating and certain non-operating activities. And revenues minus all expenses gives us the net income. The bottom line is arguably the most important part of the statement because it tells the business how much money it's actually making. You can also turn this number into a percentage to understand a company's profits as a percent of sales. Let's look into each step in preparing an income statement now. Step 1. Calculate total revenue. Once you know the reporting period, calculate the total revenue your business generated during that period. If you prepare the income statement for your entire organization, this should include revenue from all lines of business. If you prepare the income statement for a particular business line or segment, you should limit revenue to products or services that fall under that umbrella. Step 2. Calculate cost of goods sold, or Cogs. Next, calculate the total cost of goods sold for any product or service that generated revenue for your business during the reporting period. This encompasses direct and indirect costs of producing and selling products or services, including direct labor expenses, material expenses, parts or component expenses, distribution costs, and any expense directly tied to the production of your product or service. Step 3. Calculate gross profit. The next step is to determine gross profit for the reporting period. To calculate this, simply subtract the cost of goods sold from revenue. Gross profits, expressed as a percentage of revenues, is called gross margin. Step 4. Calculate operating expenses. Once you know gross profit, calculate operating expenses, or OPEX. Operating expenses are indirect costs associated with doing business. These differ from cost of goods sold because they're not directly associated with the process of producing or distributing products or services. Examples of expenses that fall under the OPEX category include salaries of employees not included in direct labor, rent, utilities, overhead, office supplies, marketing expenses, legal fees, etc. Step 5. Calculate the operating income or income before interest and taxes. To calculate income before interest and taxes, subtract operating expenses from gross profit. This number is essentially the pre-tax income your business generated during the reporting period. This can also be referred to as earnings before interest and taxes, or EBIT. Step 6. Calculate interest and taxes. After calculating income for the reporting period, determine interest and tax charges. Interest refers to any charges your company must pay on the debt it owes. To calculate interest charges, you must first understand how much money you owe and the interest rate being charged. Accounting software often automatically calculates interest charges for the reporting period. Next, calculate your total tax burden for the reporting period. This includes local, state, and federal taxes, as well as any payroll taxes. Step 7. Calculate net income. The final step is to calculate net income for the reporting period. To do this, subtract interest and then taxes from your EBIT. The number remaining reflects your business's available funds, which can be used for various purposes, such as being added to the reserves, distributed to shareholders, utilized for research and development, or to fuel business expansion. Let us now look at a hypothetical income statement. In recap, an income statement typically includes the following information. 1. Revenue. How much money a business took in during a reporting period. 2. Cost of goods sold, or Cogs. The total costs associated with component parts of whatever product or service a company makes and sells. 3. Gross profit. Revenue minus cost of goods sold. 4. Operating expenses. How much money a business spent during a reporting period. 5. Operating income or earnings before interest and taxes. This is gross profit minus operating expenses. 6. Next, we have taxes paid and interest paid. These are non-operating expenses. 7. net income. Income after paying taxes and interest. For public companies, they may also report other metrics and values like 1. Earnings per share or EPS. This is net income divided by the total number of outstanding shares. 2. Depreciation. This is value lost by assets, such as inventory, equipment, and property over time. And 3. EBITDA, or earnings before interest, depreciation, taxes, and amortization. Why is this important? The main role of a profit and loss statement is to figure out whether or not the business made money in a given period and how much it earned or lost. Looking at how profitable different parts of the business are can help the company improve its performance. For example, if a retail store is earning a 25% profit on accessories, but only 10% on jeans, and accessories are selling better, it may decide to carry more accessories and fewer jeans. Prospective investors may want to see statements for several past periods before investing their money. A profit and loss statement only tells you about a company's past results, i.e., its most recent quarter or year. But those past results can give important clues about the company's future. Here are some potential positive or negative trends to watch for when you're looking at statements for several periods. Those are the broad strokes. But of course, running a business or analyzing one is complicated. Ultimately, a company's income statement gives you some important clues as to how it's been doing in the past or could do in the future. But it's just one piece of a complex puzzle. Let's watch a short video courtesy of Napkin Finance.
Profit and loss, or P&L for short, is also known as an income statement. A profit and loss statement shows a company's income and expenses, what it earned and spent over a period of time. A P&L starts with your revenue or sales. That's the dollar amount of how much your company sold through its main business activities. Then you subtract expenses. This could include the cost of inventory, employee wages, rent and utilities, marketing, asset depreciation, interest payments on debt, and taxes. By subtracting expenses from revenue, you arrive at either net income, aka profit, or net loss. A P&L can help you figure out if you're making money, what changes you've had in your expenses, and which of your products are most successful. It also lets investors know if your company is a good place to park their money. Maybe you've heard the phrase, the bottom line. It actually comes from a P&L, where profits are the last and arguably most important part of the statement. A P&L is one of your company's most crucial financial reports, telling management and investors how you're doing financially and offering clues about where you're headed.
So, in summary, a profit and loss statement shows what a company's sales, expenses, and profits were over a given period. The statement can provide valuable information for the company itself in making decisions about how to run the business and also for potential outside investors. Trends in a company's profit and loss statements can give clues about its longer-term business prospects and potentially even alert investors to any red flags. The income statement is a vital source of information, but only one small piece of the bigger picture when it comes to analyzing a company. Thank you for your time. Until next time then, stay enriched and strong.